Welcome back to the Teaching Tax Flow podcast, everybody. Episode 106 today. We're wrapping up our White House walkthroughs with part 2 of 2, and we are looking at candidate former President Donald Trump. But before we dive into this one specifically, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
All right, everybody, welcome back to the Teaching Tax Flow podcast. This, like the last episode, right, we're kind of dubbing it the White House walkthroughs. So here we are now. We're going to talk about our other current candidate here. So Donald Trump, obviously, for the other party. Last episode, we talked about Harris, discussed various areas of tax proposals that are out there in various different corners and whatnot. Some of the stuff you may have heard of, some of the stuff you may not even be interested in, but here we are again. We're going to run through these, and just a reminder, so we do not give any opinions during this. Really, we may crack a little joke here or there, but as you've already heard and watched, if you've watched any of our podcasts, that's pretty much all we do sometimes, or at least I do, right? I can't keep up with the knowledge that Chris brings to the table, so I try to bring just a sliver of comedy, kind of, in a sense, hides my stupidity sometimes. So, hey, hopefully it works. If not, oh well, tough. You're still here. You're here for the content, not for my entertainment. And let's dive into the other candidates. So again, this time we're going to look at Trump. Last one was Harris. Go back, listen to that one if you haven't. Chris Picciurro, you ready for this one, buddy?
Absolutely.
Let's do it, man. So this, again, we're going to hit all the corners that are out there in or from the information that's provided to us by the Tax Foundation. So this is not stuff that we sat around at a bar top and we decided to pull certain information and share it with you. We're doing the best we can here to compare really apples and apples, not apples and oranges too much. Obviously, there's many differences, but also many, couple similarities in here too. So let's start from the top, similar to the format we did with the last candidate on the last show. Let's look at business taxes, if we can, if that works for you, Chris.
Absolutely. Well, the first thing to remember is that under former President Trump's administration, the Tax Cuts and Jobs Act of 2017, which pretty much gets mentioned on all of these episodes, it was passed. And that goes through 2026, where there's phase outs of different things along the way. And many of what he is proposing based on the Tax Foundation is really an expansion of or continuation or permanence of the Tax Cuts and Jobs Act of 2017. But there are some variations. And there's some things to consider that we're going to jump into. So remember, we're going to start with business taxes. So thanks for teeing it up. On the business tax side, corporate income tax rate. So this is for C corporations. Mentioned this in our previous episode. So if you're hearing this twice, congratulations, have a sip of water or something. If you haven't heard it, go back and listen to the other one. But anyway, C corporations right now are currently taxed at a 21% flat corporate tax rate based on their net income. C corporations can be small taxpayers, but typically they're going to be larger organizations, while publicly traded companies are C corporations. And the big disadvantage of a C corp is that there's double taxation. So the corporation is going to pay a tax on whatever its net profit is, and then any of the dividends it pays to shareholders is taxable to the shareholder, but it's not a deduction for the corporation. So right now, corporate tax rates were dropped to 21% under the Tax Cuts and Jobs Act, and former President Trump's proposing that gets lowered from 21% to 20%. Furthermore, he wants to lower the corporate tax rate to 15% for companies that make their products in the United States. So those are domestically made products. It would be interesting to figure out how how from a tax perspective, is that going to be some type of self-certification when you prepare your tax return? Is it a box you check is Is it a percent of the product made in the United States, or does it have to be all of it? But anyway.
And those are always interesting too, Chris, because as somebody who lived literally in bird's eye view of a large port, right? I used to see vehicles come into inbound, so basically imported, and all they would do was change the wheels off of them, and it would, now they're assembled in the States. So kind of in the same comedic reference as I think we did on the last one, where Harris had proposed the tip change or taxation on tips and how people could find ways around it. There might be another one. Not that we're sneaking here at the podcast, but
well, yeah. I mean, there's always ways to tax plan. So anyway, corporate tax rates go down under former President Trump's proposal. He doesn't have any changes to capital gains or dividends because remember, right now, long-term capital gains and qualified dividends are taxed for the vast majority of taxpayers at only 15%, a special tax rate. For some taxpayers, it's at 0, and for some high-income earners, it's taxed at 20%. A long-term capital gain is selling an asset that you've owned or an investment. It could be a stock, bond, mutual fund. It could be real estate that you've owned for at least 1 year. And then qualified dividends. Remember, I mentioned dividends paid from those corporations. Qualified dividends are dividends paid by corporations where you've owned that share of stock for at least 1 year. So remember, one of the 3 laws of teaching tax flow, that tax agencies are your involuntary business partner. Tax laws written to encourage and discourage certain behavior. So right now, under the Tax Cuts and Jobs Act, what does that tell you? It tells you that buy and hold is taxed at a much lower rate than stock trading or owning things only for a year or less. So I don't see any changes proposed right now to the capital gain and dividend because it's already where they want it. Former President Trump's wanted it to be when he won his first election. Now, this is where it gets tricky, John. Credits, deductions, and exemptions. Remember that example I used in the previous episode. So we talk about tax brackets. Remember, your marginal tax rate is way more important than your tax bracket. It's the number one KPI when it comes to tax planning. Your marginal tax rate is a tax bracket is a static bracket that says from these taxable incomes, this is the tax you're going to pay for that trench of income. Well, tax credits, deductions, and exemptions are not part of the tax bracket, and they get phased out based on income in a variety of different things. So if you're driving around, listening to this, running, walking, hey, if you're outside walking, running, congratulations. You're doing some exercise and you're learning something. However, this is my example of when you go and buy a ticket on any type of ticket exchange. The ticket might be $50, but because of some type of quote unquote convenience fee, technology fee, administrative fee, the ticket's $68, right? So when you're voting, not just nationally, locally, and in your state elections, when candidates say that they're not going to increase a tax or your tax rate, that might be true, but that doesn't mean your marginal tax rate's not going to go up due to these credits, deductions, and exemptions. So these are your, I'm not going to call them hidden taxes because they're not hidden. They're not on your bill until it comes to the table, right? It's one of those things. So, former President Trump's vice presidential running mate, J.D. Vance, has discussed increasing the child tax credit to $5,000. Remember with Vice President Harris's proposal was that the child tax credit is phases, is a little higher for under 1 year old and then phases down. The child tax credit right now is at $2,000. So that would be a significant increase for the child tax credit. Now, remember, those child tax credits, doesn't matter who your candidate is, there's probably going to be a phase out of that child tax credit based on income. So you have to think about that. So when the Tax Cuts and Jobs Act was enacted, one of the major issues for the higher state income states, it's a mouthful, was the phase out of what we call the SALT tax deduction. SALT is not something that you're putting on your French fries. SALT is state and local income tax. So for taxpayers that itemize their deduction, they can only deduct up to $10,000 of state and local income tax. Well, John, if Now, there are some strategies if you own a business that is a partnership or S corp to maybe boost that up or get that as a business deduction. But John, let's say you live in the state of New York and you have a combined W-2 wages of $30,000 or $300,000. You could very well be paying $18,000 of state tax. You could be paying $12,000 of property tax. So you're paying $30,000 of property taxes and state income tax. Right now, you only get to deduct $10,000 on the federal return. So that $20,000 goes bye-bye. So what he has mentioned is that the reinstating of an unlimited itemized deduction for SALT taxes and discontinue that cap as part of the Tax Cuts and Jobs Act extension. Well, that would be a major shift for those higher income states. We always have to talk about California, Illinois,
We have to.
New Jersey, New York, but golly, there's people that are modest incomes. Let's say it's a household in Michigan, right? Let's say they have $150,000 worth of household income. They're paying 4% of state tax, let's say $6,000, but let's say their property taxes are $9,000, $10,000. That's not unreasonable. Right now, they're only getting to deduct about 60% of that. Now they'd be able to deduct all of it. So that's something to take a look at. And we'll see, and who knows, it could be phased out by income. We just don't know. Estate and wealth tax. So right now, we are in a situation where someone could pass away with about $13 million worth of assets and pay no estate tax. And that's part of the Tax Cuts and Jobs Act. That phases away in 2026 down to a much, much lower amount. And one of the proposals that former President Trump has is that to make the higher estate tax permanent under the Tax Cuts and Jobs Act. Because right now it's going to go back, I think, down to $5 million, which is still a significant amount of assets. But, not too long ago, the estate tax exemption was $2 million. Now, that's a lot of assets. That doesn't mean, when we talk about estate tax, just for people listening, that means all of your assets. I've worked with several clients, especially 15 years ago when I was really more in the tax prep side of things. But gosh, I had clients that maybe bought a home in a nice area outside of Detroit. They've paid it off. They're 80 years old. They've taken required minimum distributions out of their IRA, but they've got $1 million in their IRA. They've got a home worth $1 million, and they have a life insurance policy for $500,000 and some other assets, savings. So it's not like they are rolling in the dough. They're genuinely concerned about, is that $1 million of cash going to last them the rest of their life? That's in their retirement account. Because their other assets they can't grab their life insurance, and they can't, unless they sell their house, they're not going to have the equity from that house. So the point is, they would be subject to an estate tax if the estate tax exemption was back down to $2 million. What we would say, let's be honest, John, if you're advising someone to retire right now, and you live in middle America, how much in assets do you think you need?
But it's a tough one. And now almost to answer that one too, Chris, to answer it but not answer it, right? And this is my own personal opinion, not political at all. It's almost like I feel that even within my circle of friends, right, I feel that lifestyles now are becoming more and more polar opposites. There's not as many that are, comfortable in the middle. You either have over here or you have, way down there too. So, and that kind of goes back a little bit even to one of the proposals that Harris had made, regarding the starter homes, right? I learned something from that one regarding a look back period, which I just figured, hey, a starter home has to be your first home ever in your name, or the first one you've ever lived in that you've had ownership in. But then, some of this stuff, it's interesting. It's very interesting. And to be totally honest and transparent with everybody, this is probably the most in-depth this election that I've ever actually looked into proposals as it relates to taxes, not just proposals it relates to other things. You know what I mean? So this is very interesting.
Well, we're gonna so yeah, we'll see what happens there. But the point is the estate tax exemption now, if it comes back down, is going to hit a lot of people that it wouldn't really affect before. And if you're listening to this in an estate planning attorney, you might be licking your chops, you might be rolling your eyes. I don't know. You're going to have a lot more planning to be done. Former President Trump does want to tax private university endowments. So many of these larger universities, they're not even large universities. A lot of them are older universities that have endowment programs that have significant amount of assets. He wants to tax them. And in 2022, I think 58 institutions paid $244 million of tax under, which for the first time. So for the first time in 2022, these endowments had to pay a 1.4% tax. So he's looking to increase that. That really doesn't affect too many people listening to this podcast.
Right.
Now, let's jump into the personal side of things. So this is where things get really interesting. What he's proposing is we make the expiring individual income tax cuts in the Tax Cuts and Jobs Act permanent, and that means that a lot of the where we're at with the tax brackets. You know that I'm a big advocate of understanding what your marginal tax rate is versus a tax bracket, quote unquote. But just to give you an idea, when you compare tax brackets from 2017 to 2018, which is when the Tax Cuts and Jobs Act went into effect, of course, our friends at the Tax Foundation did this as well. You'll see that for a married couple filing jointly, okay, at a, let's just say, $300,000 income level, they're in the 24% marginal tax bracket now. Previously, before Tax Cuts and Jobs Act, they were in the 33% tax bracket. So the point is, these tax brackets that we're in now, you're probably sick of hearing me say this, John, that taxes are on sale. Taxes would potentially go on sale permanently, I guess. I don't know if the Tax Cuts and Jobs Act brackets were made permanent. If not, we're going back to the pre-2018 tax brackets, which are significantly higher.
Mm-hmm.
So that's something to consider. Now, how do you pay for that, right? Because you can't just cut everyone's taxes, can you? And we're going to jump into the President Trump, or former President Trump, I should say, is a big advocate of increasing tariffs. So I'm going to touch on that in a couple of minutes, but let's stick in the individual tax side. I mentioned reinstating that itemized deduction for state and local income taxes. There's a lot of people in those higher tax states that did not like getting that limited, because ultimately, John, if you're paying, think about it, between property taxes and income tax, 15% of your income to taxes that you can't even deduct, and that's a significant amount. Also, right now, when you put money into the Social Security system, that's going through your paycheck, you're paying self-employment tax. You are not receiving any type of deduction for that. If you're self-employed, you get a deduction for half of it. But ultimately, it's the employee hat, not the employer hat. You're not getting a deduction for it, and then your employer funds it and matches. So you're putting ultimately after-tax dollars into Social Security. When you start drawing Social Security, it can be non-taxable, but the vast majority of people pay tax on their Social Security, because I think your income has to be like less than $25,000 for you not to pay tax on your Social Security. And that maximum rate, which escalates quickly, is 85%. So a lot of people are paying tax on either 50% or 85% of their Social Security income, even though they didn't get a deduction for it when they paid it in. This is the first time, and again, I've only been doing this for 20-something years, I've seen someone really stand up and say, I want to exempt Social Security benefits from taxation. So we'll see what happens, but that's what he is proposing. Interesting, though, John, on this one, both Vice President Harris and former President Trump have proposed exempting tip income from taxes. And interesting. So that's been really, really interesting. We'll see what happens on that. I mean,
kind of as we touched on in that other one, right, and a little bit earlier here too. That's a really tricky one, because there's almost pros and cons, but it's almost from a managerial standpoint. It's, which way do you go about it? Because if I remember right, and again, I don't know this, is it a state or is it a federal minimum wage for?
Off the top of my head, I don't know. I know each state has different. I think there's a federal minimum wage, and then states could either adopt that or they can make their own minimum wage, which is potentially higher. I really don't know.
It's like $3 or $2 or something like that. But yeah, that'll be interesting to see how that one plays out. And again, that's, as we mentioned previously as well, these are only proposals. They're the likelihood of, I wouldn't say anything on either side going all the way through to the finish line, without tweaks and changes and modifications and, agreements between stuff is kind of slim on some stuff. So give or take all the way. Politics 101, really, right?
Well, we're gonna see what happens if there's bipartisan support of exempting tip income from taxation. It might very well go through now. And if you think about it, John, though, I could see, tip income. Obviously, it's going to take away from the money going into the government, but it could. I mean, you can make the argument, and I'm not trying to make this. I don't know how I feel about this yet, but that it's a gift. Like, hey, you gave me great service. What's an extra $1 or $2? It's because gifts aren't taxable,
right?
So now, but you're going to have issues, right? You could have issues that there's always going to be people trying to circumvent these rules, So what if you have someone that's trying? I'm sure family members are going to be exempt from this and all that stuff. But anyway, once these things get passed, and as we have a president-elect out of our two candidates, we will definitely have more content on that. Former President Trump also wants to exempt overtime pay from taxation, which is interesting. What's over now? Overtime in my books usually over 40 hours for the week or over 8 hours in a day for hourly employees. Now let's talk about payroll taxes. We talked about, with payroll taxes, how are those affected by potentially the Social Security benefits being exempt from tax and tax being not having to pay tax on overtime? Would you owe the Social Security on the overtime pay, or is it exempt from all taxes, including federal tax? We'll have to see how this shakes out. Now, the tariffs. Okay, so obviously everything I've talked about, except for slapping these private university endowments with a higher tax, are tax reductions. So if you're reducing taxes, there could be a variety of things that happen. There's more money in the economy, et cetera, et cetera. But where is he looking to increase? And these are very, very significant. All right. First, impose a universal baseline tariff on all U.S. imports of 10% to 20%. So that's on any import. That's a significant tariff, and we know a tariff is basically a tax on those imports. The second one is extremely targeted. Impose a 60% tariff on all U.S. imports from China. That's significant. That would obviously have some ramifications all over the place, right? It'll trickle all around. But that's what's getting proposed. And
like you mentioned, a lot. Obviously, it's proposals, right? And the trickle out, kind of the ripple effect, right? It could be good, it could be bad on either side. Who knows? The elimination of tax on tips could be the greatest thing we've seen in a long time, and it may have very little to do with that. Maybe car sales would go up, but yeah, this is why I'm not an economist. I stick in the marketing world. But yeah, to your point on that one, it's almost everything here it's almost at face value for as much as we know, right? Is what it's worth.
Exactly. And if that Tax Cuts and Jobs Act does get set permanent, here are some of the just thoughts about what that would mean. Lower rates and reconfigured brackets, the qualified business income deduction, QBI deduction, or Section 199A deduction for past or business income. That's those small taxpayers of up to 20% would carry on. Larger estate tax exemption would carry on. 100% bonus depreciation would most likely come back and be permanent. Okay, so that's when you talk about the cost segregation studies and small business owners investing in assets, that's something that people have to think about. And so it's interesting, and so just like Vice President Harris's proposals, the Tax Foundation took a look at what would this mean to full-time employment, full-time employee equivalent. So in other words, would it add jobs, do they think, or would it reduce jobs here in the United States if all of this was passed? So if all of it was passed, the Tax Foundation feels that it would be a reduction of 387,000 jobs. Now, interestingly enough, the tariffs, the one for China and the universal tariff going from 10 to 20%, the Tax Foundation feels it would reduce jobs by over 1 million jobs, which means the other proposals, so for instance, like making the Tax Cuts and Jobs Act changes permanent, the Tax Foundation would increase the full-time equivalent employment by $792,000. So again, while all these, for Vice President Harris and all of her proposals and former President Trump, not all of these aren't going to just get passed, but these are the things that will get negotiated. Probably, we'll see something in the middle. Who knows? We'll have to see what happens. There's a lot of every House of Representatives seats open. As we know, a third of the Senate seats are open. We'll see what happens. But
so you're saying I stand a chance.
So yeah, Sparty still could get in there with a write-in with Cooper, and you never know. But that's the theme is reducing the taxes domestically and increasing tariffs.
Absolutely. So, well, Chris, I'm glad we went over these, and I am really happy with the way that we kind of I'd say the overview on each of these. Right? I know we had some discussions of, do we do a separate episode per focus area? Do we do one like we did here, separate episode on each candidate in no specific order? And I'm glad we went about it this way because some of these areas, right, we have more information than other ones. Some of them are to be determined. And even at this time frame, it's not like this election is tomorrow. There's going to be some time. Things may change. People may change positions a little bit, et cetera, et cetera. So we don't know. I mean, and again, I'm not a politician, nor would I ever want to be one in Washington. But yeah, there's a lot of stuff that goes into that. And again, as we mentioned earlier, it's, in wholehearted transparency, it's a different point of view to look at a lot of these candidates, almost strictly looking at it from tax purposes and what's being proposed and, where things could affect other areas and vice versa. So I'm really glad that we did it this way. I know we were kind of bouncing back and forth, but if you guys have any questions on this stuff, I mean, as we mentioned here and on the last one as well, Tax Foundation is a fantastic resource. So you're going to find nothing but factual information that's out there. It's not being, put on there as a message board forum. It's actually vetted and put out there by the organization themselves. So we always, from Teaching Tax Law, we always reference that as a very credible source on our end. So we encourage you to do the same. But Chris, unless there's anything else to add here, I mean, if Sparty was running for president, let's ask you this question. What do you think her messages would be? Like, what would her marketing, what would her campaign slogan be? I don't know. I know Cooper.
Less barking and more cuddling.
Oh, I'd see.
Should make an awesome president, John.
I love Sparty.
Except the one that is yours.
I haven't had one in a couple weeks. I got to go back to the drawing board and come up with some good ones. I got nothing. Although I'm dealing with a almost 4-year-old at home who now is in the phase of saying no to me over everything. So My dad jokes are more like, oh my gosh, just leave me alone, kid. But anyways, well, this wraps it up on our White House walkthrough kind of comparison on these tax proposals. So again, go back and listen to these. They are date and time stamped when we release these. So if things change, don't come looking at us and blame us and say that we put it out there and it's not true. These are pre-recorded. These ones specifically are not live. But any questions you have, best place you can even drop those in. But proceed with a little bit of caution given the sensitive nature of the topics in some sense or another. Get on Defeating Taxes. That's our private Facebook group. Defeatingtaxes.com will take you directly there. Join the group. Ask the questions. Obviously, please keep them tax and business and finance related. But do it. I can honestly say this, Chris. I think in the couple years that we've had that group, I can't even think of one specific time that we've had somebody kind of step out of lines where we had to play the moderator card. So I think we're kind of proud of that one. But
people stay. Yeah, we have a great group of people, and that's part of the reason that we made it a private group, right? You've got to agree to be not. You can't be a meanie. Jump in. Seriously, jump into Defeating Taxes. Let's start getting through here, because ultimately, once you go to teachingtaxflow.com, just drop your name, email address, stay in touch, because we're going to have a bunch more content, and we're going to keep going, because ultimately our community drives the content, not us.
Absolutely. And thank you, Chris, for running through this again. We covered so much information these past 2 episodes. I know I usually have my sticky pad notepad next to me. I had to retire it for a full-on notepad. This puppy's got a lot of notes. So as always, close it out with, we'll see everybody back here next week, roughly the same time. It will be a different topic this time here on the Teaching Tax Flow podcast. Thank you for joining us.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.